recording as well. So, hello everyone. Welcome to the Economics Club's first event of this year. Today, Professor Azizi will be presenting on the economic impacts of COVID-19. So, go ahead, Dr. Azizi.
Hello, everybody. And so I'm going to share my screen. Post disable participant screen share. Okay. Would you please just let me share my screen?
Does that work?
Mm. I'm going to make this big. Let me see. Share screen. And share.
Okay.
Okay. Can you guys see my screen?
Yes.
Okay. I'm going to make this even bigger. Okay, and I'm gonna, okay. Can you guys see my screen right now?
Yes.
Yeah.
Yeah.
Awesome. So economic impacts of COVID-19. I'm going to talk about, first of all, I'm going to show you a couple of facts, couple of statistics that we have, and then we are going to have definitely questions and answers, and I tell my opinion, and you guys definitely ask questions. You guys tell me your opinion, and we'll see what happens. So number one slide that we have is the unemployment rates that we have in the United States. So unemployment rate, the source of this data set is from tradingeconomics.com, and they got it from US Bureau of Labor Statistics. Bureau of Labor Statistics, or BLS, is one of the primary sources of data in economics, and it's 100% reliable. So the unemployment rate in October 2019 was 3.6%, and then 3.5, 3.5, 3.6, January 2020, February 2020, 3.9, and right after that, from March, it was 4.4, but from April that we had the shutdown, it went to roof, and it was like 14.7. And after that, it's going down, but the speed that it's going, so it was 14.7, 13.3, 11.1, 10.2, 8.4. But in September, in August, unemployment rate went down, but only 0.5%. So from now on, there is a very good chance that unemployment rate still will go down, but not as fast as like we had from April to May, or from May to June. So from May to June, it was 2.2%, which is a great deal. But from uh, August to so this is July, this is August to September, it went down only 0.5%. And maybe just next month it goes down even less than 0.5%. So maybe 0.3, 0.2, something like that. And it might take several years for unemployment rate to go back to like the level that it was before COVID-19, maybe to something like 4.4, 4%. It might take a couple of years for that. That's one slide that we have. And the unemployment rate might stay around here for a while until we get the vaccine, and until the economy, everything goes back to the natural way that they were before COVID-19. So it might just stay here or just go down just a little bit. And you guys, if you have any questions, definitely ask me and interrupt me whenever you want, okay?
Do these unemployment rates include people who were laid off, or only those who lost their jobs?
So definition of unemployment rate is it includes everybody who is willing to have a job, and they're looking for jobs, but they cannot find a job. So let's say that you are a student and right now you don't want to work. So you won't be even in the labor force. Unemployment rate is only those people who are in the labor force, which means who are looking for jobs, and then you got to be actually actively looking for jobs. So if they were laid off and but they wanted to have a job and they were looking for jobs and they were applying for jobs, but they couldn't find a job, they were part of this 14.7%.
Okay, thanks.
Sure. There might be some cases that they were laid off, but they thought, okay, maybe I rest for a couple of weeks or a couple of months. Right now, I'm getting these unemployment benefits from the state and federal governments. So those people, they are not even here. If you want to include them, it's going to be definitely way higher than this. This is only people who were looking for jobs, but couldn't find a job. So in economics, we have something called discouraged workers. Discouraged workers are workers who have been applying for jobs for a while and they couldn't find a job and they just gave up because it's just too hard to find a job. This does not include discouraged workers. This is only people who were actively looking for jobs and applying for jobs, but they couldn't find a job. Next slide that we have, I have is about interest rates. This is historical interest rates in the United States. Can you guys see it like clearly? Is it?
Yes, it's very clear.
Okay, nice. I included the website that I got this interest rates as well. This is the website, macrotrends.net. But again, the source of all of this data is Federal Reserve. Uh, so in 1980, that time it was really high, around up until even around 20%. Inflation rate was also very high at that specific time period. But something that we can focus is maybe after 2000, I don't know, 2007. So at 2007, 2008, interest rates were around 5%, something like that. But right after financial crisis, during financial crisis, and these gray columns, they show financial crisis, something that we have like any difficulties that we have in the economy. So in 2008, 2009 financial crisis, unemployment interest rates went down from around 5% to near zero. And they were near zero for a couple of years until 2015. And I clearly remember in 2015, the TV was announcing that, oh, now they are raising interest rates by, usually they raise the interest rates by 0.25%. So a quarter of 1%. And they went up until like around 2.5%. And right at the beginning of COVID-19 crisis, Federal Reserve decreased interest rates from 2.25 then to like 1.75 and then from 1.75 to around zero. One question, these interest rates that we are talking about, let's say you want to buy a house. Can you go and ask for a loan with zero interest rates? Is it effective interest rates for people?
No.
It is not. So if you want to go and buy a house right now, you won't be able to get 0% interest rate. This is like interest rates that Federal Reserve gives to commercial banks. Let's say you're Chase or you're Bank of America and you need money, you can borrow money from Federal Reserve. Federal Reserve usually charges some interest rates. This is the interest rates that Federal Reserve charges those commercial banks. But those commercial banks are not going to give you loans with zero interest rate or 0.25%. They have like some costs. They have labor, they have like many branches, and they have huge amount of cost. And in addition to the cost, they're gonna make some profit for themselves. So usually they add something around 2.5 or 3% to this, and then you can get that one. So right now, if you want to get if you want to buy a house, the interest rates that we have is around 3%. Now, this is historical interest rates. One thing that is more interesting than historical interest rates or about anything else, finding data is very easy. All you got to do is to just Google historical interest rates in the United States. But the more exciting thing, or the thing that we should look for, is like future interest rates or future, let's say, unemployment rate, future stock market, gold market, or real estate market. What do you think about interest rates in the United States? Again, this is Federal Reserve interest rates, or which is right now is around 0%. What do you think about interest rates in the United States for the next 2 or 3 years? Is it going to stay around zero, or it cannot go by, like in the US, we don't have negative interest rates usually. So it's not going to be negative. Is it going to stay around zero, or is it going to go up? Is it going to become like 1%, 2%, 3%? What do you think?
Well, they keep the interest rates low to encourage borrowing, correct?
Yes.
Then I think they will keep it low because I don't think the economy will be completely back to normal for at least a few years.
Yeah. Anybody else?
I also think it will remain normal, remain the same until, of course, the next economic crisis will hit us.
Yeah, both of you are exactly correct. Federal Reserve publicly announced, and this is not something that they do on a regular basis, but the Federal Reserve publicly announced that they are going to keep interest rates around zero for the next 3 years. So it's going to be around 3%, around 0% in 2020, 2021, 2022. So this is very important news, especially if you are like if you are interested in the I don't know, stock market, if you are interested in buying a house or anything like that, or if you want to finance a car, all of these are related to the interest rates that Federal Reserve has, Federal Reserve funds. So, and we know that that's going to stay the same. The reason that they're going to keep the interest rates around zero, as Taylor said, is that because they want to encourage people to buy more stuff, to buy more cars, buy more houses. They want to encourage the demand part of the economy. If they increase interest rates, then people are not going to do that. But if interest rates are really like down, like around zero, then people are going to have more incentives to buy houses, to buy cars, and to buy many more stuff. So in order to do that, they're keeping interest rates really around zero. Any questions about interest rates, historical interest rates, or future interest rates in the US? Okay. Next topic that we have is the stock market. So this is stock market. For stock market, we have a couple of different indices. We have the Dow Jones Industrial Average. So I have the little bit short definition of this Dow Jones Industrial Average, which is a stock market index, measures the stock performance of 30 large companies listed on stock exchange in the United States, there is something called market cap. Market cap is like the market value of all of these 30 companies together. There are at least two more important stock market indices. Does anybody know what other important stock market indices we have?
What other stock market important stock markets we have? Stocks we have?
What other stock market indices we have besides Dow Jones Industrial Average?
SP 500 would be one of them.
Exactly. S&P 500 is another one, and then Nasdaq is also another one. S&P 500 is much bigger than this. The market cap for S&P 500 is around 28 trillion dollars. For this is only $8 trillion. S&P 500 is around like 504 companies, I guess, right now. Most of them are American companies, but I think maybe around 20% of them are also international companies. But all of these indices, S&P 500, Dow Jones, or Nasdaq, they are highly correlated to each other. What does it mean? It means that when they go up, one of them when usually go up, the other one also goes up, one of them goes down, the other ones also go down. It might be a little bit different. For example, maybe Dow Jones goes up. Today it was up 1.68%, and then maybe S&P 500 is like 1 point, I don't know, 5%, and then Nasdaq is might be 1.8%, but it's usually they are very highly correlated. Now, something that we can see here, we have here the stock market for last 5 years. Stock market indicator, for example, Dow Jones indicator, has been going up since 2010, 2011. So it's been in a very something called like stock market. We usually use like two phrases: bull market and bear market. So it's a bullish market for a really long time. From 2000, bullish market means stock market that is all indices are going up and it's really good. So it's been going up since 2011 until February, almost end of February. And then after that, we had this big drop in the stock market, but it recovered really fast. So it's called like V-shape stock market. It's almost V-shape, as you can see. Stock market, however, is not necessarily showing how the economy going on for everybody. It is impacted by so many other factors. One factor that is very important and impacts stock market is interest rates. And the relationship between interest rates and the stock market is inverse. So I can put it in this way. Let's say you have $10,000 and you're hesitant that if you want to invest your money in the stock market or if you want to buy bonds. So bonds usually are very safe. Let's say governmental bonds are very risk-free, yes? Because you know that you are going to get something at the end of the year. So it's risk-free. Let's say you get 2%, 3%, something like that. Stock market, however, is very volatile. On average, in the long run, stock market usually pays off something around 10% per year. but it does not mean that in any specific year you will get 10%. Sometimes it goes way more than 10% up. Sometimes it doesn't go up at all, or it goes down as well. So one factor that impacts that is, so as an investor, you have, for example, bond market and stock market, and these two markets are somehow rivals, yes? So when interest rates are really high, then you don't have that much of incentives to invest in the stock market. But if interest rates are around zero, as you just saw, it's around zero right now, and it's going to remain around zero in the next 3 years, then many people that they have cash, one market that they might invest in is in the stock markets. I'm not saying it's the only alternative. Other alternatives are gold market or real estate market, and a couple of other competitive markets as well. But definitely stock market and bonds markets are competitors, and bond market depends on the interest rates, but stock market is related inversely uh, to interest rates. So since interest rates are going to be around zero, that's a good news for stock market. However, just let me ask you this. Another factor that impacts stock market is something called corporate taxes. Now, how many of you watched the first presidential debates?
I unfortunately did not.
I did.
Okay. And Stevens?
I've only seen like clips from
Yeah, I
it.
did.
Okay, nice. So you mostly says you have seen that. Do you remember what Vice President Biden said about uh, corporate taxes if he becomes president?
No.
I don't
Didn't he say he
recall
wants
it.
to raise them?
Yeah, exactly. He said he wants to raise them. Right now, before President Trump, uh, corporate profit tax. So let's say you have a corporation. You make some profit, but on the profit that you make, you have to pay some taxes to the federal government. That's called corporate taxes. Before President Trump, it was 25%. President Trump reduced the corporate taxes from 25% to 21%. Right now it's 21%. That indicator hugely impacts stock market because stock market is nothing but just corporations, yes? All companies there are corporations. And let's say if they are making $100 million a year as profit, gross profit, then it matters if the corporate taxes are 21%, they have to pay $21 million to the government. How much do they get after taxes? It's going to be $79 million. But if, for example, taxes go up, corporate taxes go up to 28%, as Vice President Biden talked about, then they have to pay 28%. Then if they make $100 million before taxes, they have to pay $28 million to the government. So they get $72 million home rather than 79. So their profit goes down. And if I can tell you one thing about stock market is that the most important indicator that impacts stock market is how much net profit companies are making. So stock market will be affected by even presidential election, and if Trump wins or Biden wins. Personally, I think if Biden wins, because he's going to raise corporate taxes, that's not a good news for stock market. Again, I'm not saying it's a bad thing. I'm not saying that's a bad thing for the economy. We need that money. We have a huge budget deficit right now, That I'm going to talk about that later on. But for the stock market, that's definitely a bad news because corporations, big corporations, have to pay more taxes. Uh, Remember that, however, big corporation, that's usually like a lot of like rich people, let's say Jeff Bezos and Bill Gates and Mark Zuckerberg, and those people have huge amount of stock. So mostly those people will be affected. However, some other people will be affected as well. If you have invested in stock markets, you'll be affected. Or some people that have like some retirement plans like 401k or 403b, those plans also might be affected as well. But it will be affected by presidential election. It will be affected by how much interest rates are going to be, how much zero or not. But one thing that is absolutely hard to predict is stock market indicator. And I might have my own idea, but I might be totally off. It doesn't mean that anything. I personally think 2021 is not going to be a very good year for the stock market. If President Trump wins, it's gonna stay around the same level, maybe. If Vice President Biden wins, it's gonna go a little bit down, and in any scenario, it's not gonna go up because it's been going up for from 2010 to 2020. It's really high, but again, it's my just personal opinion. It's really hard to predict stock market. Any questions about this slide, or the relationship between stock market and COVID? Okay. Uh, Another thing that I want to talk about is about economic impact of COVID on gold prices. So gold prices here again, I have the website here. The website here is goldprice.org. This is like kind of like the reference for gold prices. It also has like silver price, and you can modify it for like different time periods, 1 day, I don't know, 30 days, 1 year, 2 years, 5 years, 10, 20, 30 years. So in the past 5 years, the gold prices until 2019 was around. So the measurement that we have here is US dollars per ounce. And per ounce, it was around 1200 until 2019. Now, from beginning of 2019 to almost beginning of COVID-19, uh, almost March, it went up from 1200 to 1600. But right after COVID-19, it went up from 1600, 1500 to around 2100. And then after 2100, it was around 2 months ago, it went down from 2100 to today it was $1,911. Now, again, predicting gold prices is not an easy task, and it's a function of so many other variables. Definitely interest rates is one of them. Exchange rates is one of them, and other factors. Let's just let me ask you these questions, and maybe we can talk about gold prices in future a little bit. What do you think about the relationship between exchange rates and gold prices? What do I mean by exchange rates? For example, US dollars versus other currencies, US dollars versus, let's say, euro, or like China's yuan, or other currencies. If US currency gets stronger, what's going to happen in the gold market?
I think exchange rates and gold price, gold price are correlated directly. The more exchange happens, the more people are willing to buy gold. But I might be
Uh,
wrong.
okay, let me modify my question in this way. If US dollars get appreciated, what's going to happen to gold market? So right now, let's say one euro is, let's say, $1.2. Now, with appreciation of US dollars, it means US dollars becomes stronger. So rather than 1.2, it becomes as valuable as euro. Then what's going to happen to gold price? Remember that not only Americans buying gold, but also Europeans are buying gold, but also like Indians and Chinese people and all over the world are buying golds. And when they are buying golds, they usually care about their currency. So if if US dollars gets appreciated, it becomes stronger. Uh, do you think gold prices go up or go down usually?
Gold would go down.
Yes, they will go down because uh, like let's say US dollars becomes really strong, then gold becomes like people in like other countries like right now. Okay, I can put it in this way. Right now, what's the gold price in euros? Let's say it's like 1911 divided by, if I'm not sure if about the exchange rates between US dollars and euro right now. Let's assume right now it's 1.2, okay? Then what's going to be the gold price in euro? It's going to be 1911 divided by 1.2. So it's going to be something maybe around 1700, yes? Now, if US dollars becomes appreciated, becomes stronger, then the relationship between US dollars and euro becomes 1 to 1. So 1 euro becomes $1. Then in that case, so right now it's 1700 in euro. Then in that case, if gold prices wanted to stay as it is in euro 1911, it's really expensive for them. For them, right now it's 1700 in euros, but if euro versus dollars becomes 1 to 1, then it's going to be 1900 for them, and it becomes expensive. And anything that becomes expensive, you don't want that. You want to sell it, and price goes down. So one very important indicator that impacts gold prices is exchange rates. Another one is interest rates. Usually, if interest rates are going uh, down again, usually people might be more interested in gold, and because again it's a competitive market between gold and bonds. But specifically, what was the motivation for the gold prices to just go from 1500 just a couple of months ago at the beginning of pandemic to 2100, and why did gold prices in US dollars went down from 2100 to 1900 right now? So this is what, when we can talk about the relationship between the economic impact of COVID-19 and gold prices. So before talking about this, the impact on gold prices, let me ask you this question. What do you think, where do you think we are getting these stimulus packages that the government is giving out? Let's say 1,200 paychecks that we received from the government. Or let's say the unemployment insurance, the federal unemployment insurance, that was $600 per week. That's a huge amount of money. They also paid a lot of money to airlines. They paid a lot of money to small businesses. So it was around $3 trillion money that US government gave to people and corporations and small businesses. Where do you think that money come from? What's the source of that money? Is it like taxes, or is it like I don't know, does the government selling bonds? What do you think?
It's primarily taxes that they get budget on.
That's one source that it could be. Uh, However, right now the government doesn't want to tax people more. Right now the government is giving money, literally giving paychecks, checks to people, because, like, let's say people don't have money right now. They want people to have more money to spend more. So if they tax people more, it's exactly the opposite of a target they have. They want people to have more money, spend more, and the economy goes on. If they tax people more, yes, they will have, but the government can do that, but they don't want to, because it's going to kill the economy. It's not going to help the economy. It's going to exactly does the opposite. So the government can raise money by taxing people or corporation, but right now they don't want to. They want to do exactly opposite of taxes. They want to give money to people, to corporation, to small businesses. So right now that's not the source of money. What else?
Does the government lend money from someone else?
Um, the government can lend money from other people. And again, like when we talk about governments borrowing money from other people, uh, it can borrow money from, again, general population, Americans or American corporations. But again, that's going to have exactly the same people. It's going to collect money from people's hands. The government doesn't want to do that. The government wants to inject money to the economy to help the economy. If the government collects money from people, from corporations, or if they sell bonds, then it's going to exactly do the opposite. So again, borrowing from Americans or from corporation is not the source. Right now, they're just printing money. So US federal governments have the ability to print money. The Federal Reserve can just print money. Yeah, they literally can print money. And the cost of printing $100 bill is just 10 cents for the government. So the government has the ability and uses this ability every now and then to just inject money to the economy. What's the problem with printing and just producing more money?
Doesn't it cause the inflation?
Exactly, that's the answer. I can put it in this way. Uh, why the government is paying only 1,200? Why not, rather than 1,200, I don't know, $10,000 to each person? Because if they print more money and pay more money to people, then that's going to cause the inflation. So one thing that impacted that, the government gave this financial package of $3 trillion. That's an enormous amount of money. In 2008, 2009 financial crisis, the financial package that we had was only $1 trillion. Right now, up to now, the financial package that we had was $3 trillion. Right now on the House, they are talking about another financial package, which is $2.4 trillion. So they're being absolutely generous when they're talking about these financial packages. And when they're printing more money, the very first thing that happened, people are going to see, and investors are, they are smart. They're going to see that, okay, more US dollars means that it's going to become less valuable. So they want to somehow invest into some like safe havens. And the best place they can invest is in the gold market. Yes, gold market definitely has the inverse relationship with these financial packages that they give out. So one reason that gold market went down from 2100 to 1900 is the just blurry view of the second financial package. But what do you think is going to happen in the gold market if we have the second financial package, COVID-19 package, which is $2.4 trillion? Do you think it's going to increase gold prices or decrease?
It should definitely increase the prices of gold.
Exactly. That's going to have a positive impact on the gold prices. If they have that, it's really hard to guess what's going to happen in the House and then in the Senate and then with the president. Whatever opinion I have in that one is going to be, again, my personal opinion. I personally think we are going to have another financial package at some point. It might take a while, but and the amount might be a little bit undetermined. Is it going to be $2.4 trillion or more or less? It depends on the severity of this COVID-19 financial crisis. But I think we are going to have another financial package or stimulus, and that's going to boost gold prices again. But again, it's absolutely hard to predict people's behavior, like House of Representatives or senators' behavior, and if they can agree to something or not. Last topic, almost last topic that I have. So we have until 6:30, yes? Is about impact of COVID-19 on real estate markets. Now, when we talk about the impact of COVID-19 financial crisis and its relationship with real estate markets, we have to separate two things in the real estate. One, rents market, and then second is prices. So what do you think is happening in the rents market? Do you think rent prices are going up or down? Do you think average rents, like let's say in a city like Chicago or other cities, are going up or down? So this chart that I have here is not rents, it's just prices.
Rent should be going down because people are not willing to pay rent anymore since a huge unemployment.
Yeah, exactly. Right now, rents are going down. On the other hand, so far, what we have seen is that prices are going up. So this is historical data, and again, this is the source of the data that I have. And if you guys want, I can share these slides with you. But this is house prices in the United States, and the source of this is National Association of Realtors. But the average prices from beginning of pandemic has gone up a lot. So at the beginning of pandemic, it was maybe around 270,000, but right now it's 310. So you can see, look at here, in last period that we have was August 2020, and you can see that value from 1 year ago, change from 1 year ago is 11.4%. So across the country, housing prices have gone up dramatically, 11.4%. The main reason for this is, again, interest rates, because interest rates went down. Now people are seeing this opportunity that, oh, it's an amazing opportunity to buy houses, and they're buying more houses. but at some point it might end up, because those people who wanted to buy, they're gonna buy houses eventually, and this trend might be inverse. Again, it's really hard to guess what's gonna happen next year in the real estate market. Whatever opinion I have is my personal opinion. I think as people are unable to pay rents, at some point, some landlords are gonna, since they cannot collect rents, they won't be able to pay mortgages, and then we are gonna see some kinds of financial crisis, and housing prices might go down to some extent, but the important question is to what extent, which is really hard thing to guess. But I think in 2021, real estate market, at least it's not going to go up. It might go down because we are going to have a little bit of financial crisis. Keep in mind, this is my last slide. Keep in mind that unlike 2008 financial crisis, COVID financial crisis is exactly the opposite. It hit the poor people the most. In 2008, 2009, stock market went down, real estate market went down, but right now it's exactly opposite. Those people, let's say rich people, let's say people who had, I don't know, let's say jobs that they could work from home, they haven't lost their jobs, yes? What kind of people have lost their jobs? Usually people who were making a less amount of money and they had to work in person. So unfortunately, 2020 financial crisis, we haven't seen the full capacity of this financial crisis, but poor people are going to bear the burden of this financial crisis the most. As you have seen the data on like rich people and even stock market, you have seen and you have heard of this, that like rich people like Jeff Bezos and Bill Gates, they have made tens of billions of dollars. On the other hand, poor people have had problems paying rents, and eviction rates are going up. And so this is something we should keep in mind. One reason that so far real estate prices are going up is that primarily middle income families are on the demand side of that market. Very poor people, they usually rent apartments, and that's going to take some time to, if they cannot pay rents and landlords are going to have problems, that's going to have take some time. But something that unfortunately is so different in this financial crisis and 2008 crisis is the category of people who are affected with this financial crisis, which is totally different. In 2009, rich people had the most difficulties, and poor people also were negatively affected. But right now, rich people might, some of them, especially in high tech, they are even better off. And unfortunately, poor people are bearing this burden the most. Okay. Uh, do you guys have questions? I talked a lot. I didn't let you even ask any questions. Please, if you have any questions, any comments, anything.
When you talked about corporate taxes, you've said um, advantages of it being low. Well, if Joe Biden will raise corporate taxes, what is the advantage of that action?
Okay. Something that maybe we didn't have time for that, and I didn't include in this, is the amount of budget deficit that we have. So, and right now we have a huge budget deficit in the United States. Uh, I'm talking about even before pandemic. In 2019, it was $1.1 trillion. So let me put it in this way. First of all, the advantage of raising taxes is that we have to have a balanced budget anyway. We have to tax someone. We have to tax either corporates or poor people or rich people. Something that unfortunately we didn't have in 2019, 18, and before is we had a huge budget deficit. Although many people were thinking that the economy is really good and everything is like amazing, it wasn't. I can give you a very simple example. Focus on a family that father is working and he's making, let's say, $2,000 per month. If like somehow he loses his job or like they give him only 20 hours per week, he loses half of his income, then it makes for him to just borrow money from other people. But what's going to happen if, like, let's say somehow he loses his job or like he has his job, but he borrows huge amount of money from like his friends. What do you think let's say that family has two kids, one 3-year-old, one 5-year-old. What do you think those two kids were think about their dad and their economic situation? Will they be happy or mad at their dad?
Well, they will be disappointed because their dad is in debt, and
You're correct, but if they were, let's say, 15 and 18, but if they are 3 and 5, they don't exactly care about how much their daddy is in debt. They only care about, oh, last month I got only one doll. This one I got a better, bigger, and more beautiful doll, and I got a bicycle as well. So they don't think that, okay, our family has to pay this money back off, has to pay this off at some point. They care only about the current situation and what's going on and if they're having fun or not. So this was our situation in 2018, 2019. And we were hugely in debt. It makes sense if you lose your job to borrow a lot of money. So in 2000, let's say 10, 2011, we had a financial crisis and we were borrowing a lot of money, like $1 trillion, $1.2 trillion. But when the economy is good, when the unemployment rate is 3.5%, 4%, it doesn't make any sense to borrow $1.1 trillion. It doesn't make any sense to have a huge budget deficit. So what happened in 2009 with President Trump tax cuts? Yes, we had tax cuts and we enjoyed that, but we have to pay that budget deficit back, or if we are printing money, that's gonna catch us at some point in terms of inflation. So one way or another, we gotta have a budget, balanced budget. We gotta raise taxes because we have a huge budget deficit. It doesn't make any sense to have, like, you can do that and you can make people happy. Believe me, if I wanted to become a president, I would tell everybody that I would make your taxes absolutely zero. You don't have to pay any taxes, and then I would just print money. Everybody would be happy for 1 year, 2 years, 3 years, 4 years. And I don't care after that what's going to happen. But in the long run, we got to think about long run. In the long run, we got to have a balanced budget and we got to raise taxes and we got to finance government expenditures with taxes, not with borrowing, not with printing money. So we got to raise taxes. Now the question is that do we want to raise taxes on big corporation or rich people or middle income families or poor people? That's something that has nothing to do with economics. That's something that as a nation we have to decide. But we gotta raise taxes, or at some point it's gonna haunt us in terms of either inflation or huge amount of debt. Very good question.
I do have one last question. I know we went over on time, but other than paying back the debt, what else can we do to help combat inflation?
So in the long run, one and only reason for inflation is how much the government prints money. In the short run, there are other factors as well. For example, if like suddenly there is a war in the Middle East and oil prices go up from, let's say, $40 to $200 per barrel, then we are going to have inflation as well. But that's only in the short run. In the long run, the only reason for inflation is amount of money that we print, the Federal Reserve prints. So if we want to have like something like 1%, 2% inflation, the Federal Reserve has to care about this. And believe me, like I I wasn't old. I'm not old enough to remember that. I wasn't born at that time, but we had high inflation at 1975 and 1980. We had something like 15% inflation, and we might easily have the same scenario. Maybe not right now, but I don't know, 2 years from now, 4 years from now, we might have that. And I absolutely think the Federal Reserve has to resist this temptation to just simply print money because it's going to haunt us back at some point. Usually, like historically, presidents want lower interest rates and they want the Federal Reserve to print more money because it's not going to haunt us right now. It's going to come back to us after a couple of years, and then they're not going to be president, so they can blame it on the next president. But I think Federal Reserve should keep its independence. They should not print money. They should not uh, help. They should care about inflation. And in the long run, how much the Federal Reserve injects money to the economy is the only primary and only uh, determinant of inflation rates. Uh, any question? Go ahead.
Oh, no question.
Okay, Tyler and Tori, Isaac, any other questions, guys?
No, I don't have any questions.
Awesome, awesome. I hope it was useful to you guys. I'm not sure how I did. I hope you, I don't know, I try to focus on most important impacts of this COVID-19 crisis, and I try to start with historical data and then talk about future a little bit, but let's see what happens. Only time shows
Right.
what's gonna happen.
I think you did a great job on your presentation.
Thank you
Opened
so
my
much.
eyes a lot, hit a lot of topics.
Thank you so much. Thank you.
Yeah, I
Yeah.
really too. It was very informative.
Thank you.
Yeah, I
I'm
thought it was
happy.
a good presentation, and I appreciate you asking questions to us and making us engage and stuff. So thank you so much for being here today and presenting for the Economics Club. And that pretty much wraps it up for today. I'm just going to let you guys know that our next meeting is October 21st, Wednesday, 5 o'clock to 6 o'clock. So, all right. So if you guys
Awesome.
have any final questions, go ahead and ask. Otherwise, I'm going to end the Zoom meeting. All righty.
Okay, thank you very